Greetings. It is time for the inflation update that I do every month. So for this month's inflation update, we return to my familiar matrix, which longtime viewers know about. But if you're new here, I believe that inflation has to be measured in a multidimensional sense because too much of the narrative of inflation is designed to cherry pick data points and to create a false impression of things being much worse than they are, as well as to misguide people into thinking all inflation is bad and therefore deflation would be good. Now that is extremely incorrect, and it's catastrophic that people are being brainwashed into that. But I say that there are three major metrics of inflation, which are the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index, which I think is the most important index of the three, and the 10-year US Treasury yield. So very symmetrical. 3%, 3%, 3%. Unless all three of these measures are above 3%, inflation is not higher than optimal. If all three were exactly 3%, I would say that is when inflation is optimal, because inflation being much lower than 3% is also a negative for a variety of reasons. 3% is optimal for wealth creation and technological disruption, as I speak about elsewhere on this channel. The reason the Goldman Sachs Commodity Index is the most important measurement of these three is because it is worldwide. The other two are US-centric metrics. The US is the largest economy in the world, so these are important measurements, but nowhere near as important as the Goldman Sachs Commodity Index because it is unriggable in that it is a composite of freely traded commodities such as gold, silver, oil, natural gas, etc. So the claim that these indices of inflation are rigged to understand inflation is completely and totally refuted by the Goldman Sachs Commodity Index because it is unriggable and it is worldwide. This worldwide dimension is important because money printing is worldwide and technological deflation is worldwide. These are concepts that have no borders at all, and therefore the Goldman Sachs Commodity Index, which is also borderless, is the most analogous and comprehensive measurement. So on today, February 16th, 2023, we can go through our usual routine of looking at all three of these measurements. So we'll start with this one, the Goldman Sachs Commodity Index. The Goldman Sachs Commodity Index 10-year compound annual growth rate is minus 1.34%. That is deflation. As you know, oil is still around $80 a barrel, whereas it was $100 a barrel 10 years ago, and other commodities have also not risen in price. Gold is also the same price as 12 years ago, in fact. All these other commodities have failed to rise in price because technology increases the supply of these commodities faster than their consumption can rise. And this is what people just fail to understand when they claim that gold is going to go up because of money printing. A lot of gold bugs have gone insane, and the word insane is not an exaggeration. They have literally gone insane because they cannot grasp how trillions upon trillions of dollars of money printing has still not made gold go up at all. Gold is the same price as 12 years ago, and they keep saying that it's about to rise any day now, but they're wrong. There's no fundamental economic thesis under which gold can rise, and the same is true for other commodities, especially other metals like silver. So minus 1.34% deflation. I think we're at a point where almost no amount of money printing can make commodities spike in price. Remember how just a few years ago we were hearing about peak oil and other such concepts? Quite the opposite happened. We got peak demand, not peak supply, and therefore, as I said, almost no amount of money printing can make commodities rise in price over any structural basis. Now we go to the next measurement, the 10-year US Treasury yield. 10-year US Treasury yield is 3.84%. That's more than 3%. This is the metric that is above 3%. Now this is an estimate of future inflation, not past inflation, but the Treasury market is tied to a lot of things, including US government spending, the housing market, mortgage market, and so forth. So this is the one that is above 3% at 3.84%. And lastly, we go to the US CPI. At the bls.gov website, we see the US CPI, and we go here to more formatting options, and we choose all the measurements, original data value, 1 month, 2 month, 3 month, 6 month, and 12 month rates of change. And this is the CPI index. It is at 300.536, and 10 years ago it was 232.937. And we will soon go to the table that summarizes all of this nicely, but as you can see, this 1 year percentage change has moderated down after a very brief flurry higher. Hardly an event of any significance. Same with the 2-month percentage change. It's already moderated back down to its long-term low status quo. Same for the 3-month percentage change. Same for the 6-month percentage change. Even that is all the way down to its normal low status quo. And the 1 year is drifting down. It isn't down all the way yet because this is slower moving, being a 12-month percentage change, but it's already drifting down. But when you look at the 10-year growth rate for this US CPI, it is very simply 300.536 divided by 233 and take the 10th root of that. That is a 29% growth, 232 to 300.5 over 10 years, which comes to 2.6% a year. So now we go back to our matrix. So we looked at all three, the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and the 10-year US Treasury yield. And what are the results? 2.6% for the US CPI, so still below 3%. It may get close to 3%, but it's still a fair bit below that. Minus 1.34% for the most important index, the Goldman Sachs Commodity Index. It is in deflation. How can people possibly be terrified about inflation when oil is much cheaper than it was even 10 years ago, and oil is so connected to everything else, and that same is true for all other commodities as well. Most or all are much cheaper than 10 years ago because this index is at minus 1.34% a year decline. And only the US 10-year Treasury yield is above 3%, 3.84%. Now, for people screaming about the CPI and how we had temporary inflation and how that's a terrible thing until 3 days from now when you'll forget about it because eggs are no longer expensive, we go to that table that I mentioned earlier that I've also shown in earlier month videos. So all the data that we saw, 1 month, 2 month, 3 month, and 6 month, these need to be multiplied by the following factors to annualize. 1 month times 12, 2 months times 6, 3 months times 4, 6 months times 2, and 1 year. The 1 year CPI growth rate is 6.3%. That is higher than 3%, higher than it should be, but that's still a temporary blip that is already moderating down because we see that all these shorter duration windows have a low annualized rate, especially 6 month, 3 month, and 2 month. And before you say 1 month was high, well, the month before that was actually negative. So this is a very volatile measurement in the shortest sense. But this shows that inflation has already moderated down, and only this 1 year window is somewhat high and already dropping fast. It used to be as high as 9%, it's already down to 6.3. And then the longer term windows, which are more important because this is the only measurement of structural inflation, indicates that the 10-year inflation growth rate is the same 2.6% that we saw earlier. 5 years is 3.8%, and so forth. But none of these numbers are particularly worrisome. There is noise. Whenever there's a brief flurry of higher inflation for 6 months, the same people don't show up when there is a brief flurry of unusually low inflation dipping into deflation. And as we have seen earlier, Japan is already printing money again. The world is back into net money printing because they saw that inflation was falling really fast and we were at risk of higher deflation. Japan is already printing $500 billion a month, which is enough to tip the whole world into net money printing, not deprinting anymore. Money printing is net positive at present, and still inflation is this low. So it's really quite absurd for people to worry about hyperinflation. I encourage everyone to look at this video up here in the upper right hand corner, Kartik's Laws of Inflation, where I highlight all the various illogical misconceptions that people have about inflation and all the tricks they use to push this narrative for very weird reasons, because fear sells and inflation sells. Therefore, debating via anecdotes saying egg prices are high, or claiming that the US is the only country in the world, meaning that the US Federal Reserve printing money is what will make gold go up in price, even though gold is priced worldwide and the US is only one country, or claiming that deflation would be good, when in fact deflation would be far more catastrophic for most people than moderate inflation would be. And remember, the optimal inflation rate is 3% a year, not lower than 3 or 0 or deflation, 3% a year. So anyway, this was the inflation update for this month, January of 2023. And I hope you find this type of content informative because the entire media is oriented around frightening you about inflation while simultaneously training people to think that their home equity gains are not inflation, or their stock market gains are not inflation, or the fact that their job prospects are good has nothing to do with inflation, whereas in deflation you would have poor job prospects. So I hope these videos are taking your understanding of the subject to a much higher level than the mainstream narrative. Thanks for watching.